Hey everyone, welcome back to another explainer. So, if you're out there actively managing a portfolio, doing a little tax loss harvesting, or honestly, even if you just have a couple of automated investment accounts running in the background, you are going to want to pay super close attention to what we're covering today. We are talking about protecting your hard-earned tax deductions.
Okay, I want you to picture this incredibly painful scenario. You're doing everything right, okay? You're reviewing your portfolio at the end of the year, you spot a real underperformer, and you make the strategic decision to just sell it at a loss. The goal here, obviously, is to offset some of the gains you made elsewhere and lock in a nice little tax benefit. Fast forward a bit, and you see that same stock dipped even further. The price looks incredibly attractive now, so, you buy it right back. Honestly, everything seems perfectly legal, perfectly normal. But then tax season rolls around. Your accountant, or maybe your tax software, hits you with a massive, nasty surprise. The IRS has completely disallowed your loss. Just like that, thousands in expected tax deductions, poof, completely gone.
So, what just happened? Where exactly did that tax benefit go? And more importantly, why did the IRS completely reject what felt like a perfectly legitimate, highly strategic trade? Well, you're definitely not alone in wondering this. Literally thousands of investors fall headfirst into this exact same trap every single year, completely without realizing it. So, let's unpack exactly how this happens. Here is our roadmap for untangling this whole rule today. First, we'll look at the disappearing deduction. Then we'll define the wash sale. After that, we'll walk through the XYZ company example, explore the 61-day danger zone, cover some common mistakes, and finally, talk about how to actually protect those deductions. All right, Section 1, the disappearing tax deduction, losing your tax benefit.
So, the core of this whole issue really comes down to investor psychology and, well, market timing. Think about it. You sell an asset that's lost value. In your mind, that loss is now a locked-in tax asset, right? You've realized the loss, which normally helps reduce your taxable capital gains. Awesome. But then maybe a few days go by and you start thinking, I still really believe in this company long-term and wow, the price is even better right now. So you hit buy. You're probably thinking you've cleverly harvested a tax loss while keeping your position in the market. It feels like a win-win. But the IRS, they look at this rapid-fire sequence of selling and then buying right back in, and they essentially throw a penalty flag on the play. They just flat out disallow the loss.
Moving right along to Section 2, defining the wash sale, the IRS rule explained. All right, so what exactly triggers this? The wash sale rule is actually triggered by two very specific actions. First, you sell an investment at a loss. Simple enough. But second, you buy the exact same or what the IRS calls a substantially identical investment within a 30-day window either before or after that initial sale. When this specific sequence goes down, the IRS essentially steps in and says, nope, you haven't actually exited your position, so you definitely cannot claim that loss as a tax deduction right now. Now, here is the crucial point, and this is a bit of a silver lining, I guess. Your deduction isn't permanently destroyed. The IRS doesn't just literally vaporize your money. What actually happens is that the disallowed loss gets added to the cost basis of your newly purchased shares. What this means in plain English is that your tax benefit is just delayed. It's deferred until you eventually sell those replacement shares sometime down the road. But, and this is a massive but, for the current tax year, that deduction completely disappears, and that can unexpectedly and sometimes dramatically jack up your current tax bill.
Let's bring this to life in Section 3, the XYZ company example, walking through the math. Let's just run through a hypothetical sequence to see exactly how this plays out. Step 1, you buy 100 shares of XYZ company for, let's say, $10,000. Step 2, the stock takes a hit, it falls, and you decide to sell all your shares for $8,000. Step 3, 5 days later, you're feeling pretty optimistic again, so you repurchase those exact same 100 shares. Now, to any normal trader, this looks like a perfectly logical move, right? But to the IRS, it is a complete trap. Let's look at the math on that loss. You started with 10 grand, you sold for 8 grand. That is a very concrete, fully realized loss of exactly $2,000. In a normal world, you'd use that 2 grand to lower your overall tax burden. But because step 3, that repurchase, happened just 5 days later, which is obviously well within that restricted 30-day window, the IRS flags the entire thing. Boom. That $2,000 loss is immediately disallowed for this current year. Instead, that $2,000 gets tacked right onto the cost basis of the new shares you just bought. It's completely locked up. Which brings us to Section 4, the 61-day danger zone, because it is not just 30 days.
Now, I really need you to pay close attention to the timeline here because this is where everyone gets tripped up. The danger zone isn't just a month long. Most people hear 30-day rule and they only look forward into the future. But the wash sale window is actually 61 days in total. It includes the 30 days before the sale, the actual day of the sale itself, and then the 30 days after. If you buy substantially identical securities absolutely anywhere within that entire 61-day period, the IRS can and will hit you with the wash sale rule. It's like a giant net. You literally have to look backwards in your trading history just as much as you look forwards.
To put that into perspective, let's contrast this with normal, everyday investor behavior. A super common mistake is an investor selling a stock, waiting a week to sort of let the dust settle, and then buying it right back. Honestly, a week feels like an absolute eternity when you're trading in a volatile market. But to the IRS, a week is nowhere near long enough to protect your deduction. You are still sitting squarely right in the middle of their danger zone.
All right, let's get into Section 5, Common Wash Sale Mistakes, Everyday Actions to Avoid.
So, what actually trips people up? These are the 4 major pitfalls that catch people completely off guard. First, like we just talked about, is simply buying the stock back too soon. Mistakenly thinking a few days or a week is enough of a buffer. Second, and oh boy, this is a massive trap, forgetting about your retirement accounts. If you sell a stock for a loss in your regular taxable account, but then you go and buy substantially identical shares in an IRA or certain other retirement accounts, you create a wash sale issue that might permanently eliminate your ability to ever claim that loss. No joke. Third pitfall, ignoring your automatic investments. Even tiny automated dividend purchases or recurring fractional share buys will trigger the rule if they happen to fall anywhere in that 61-day window. And fourth, trading across multiple brokerage accounts. Look, the IRS looks at all of your accounts together as one single picture. You cannot hide a wash sale by selling over at broker A and buying at broker B. They see the whole shebang.
Okay, let's fix this. Section 6, Protecting Your Tax Deductions, How to Harvest Safely. Here are your rapid-fire, highly actionable fixes to keep your money safe. First up, simply wait at least 31 days after your sale before buying the exact same investment again. Literally count the days on a calendar. Second, if you really want to stay in the market and not miss out, consider buying a different investment that gives you similar market exposure but isn't considered substantially identical. For example, swapping one tech sector ETF for another similar but differently constructed tech ETF. Third, go in and immediately turn off automatic dividend reinvestments on any asset where you are actively trying to harvest tax losses. Just shut it off. And finally, keep incredibly detailed, meticulous records of your trades throughout the year across all of your platforms. Organization is absolutely your best friend here.
I really want to leave you with this core thought from our source material today. The wash sale rule doesn't stop you from investing, but it does affect when you can claim your tax losses. Seriously, a little bit of planning goes a long, long way. Understanding this one specific rule doesn't limit your options. It actually empowers you. It empowers you to avoid nasty tax surprises, save a ton of money, and make much smarter strategic investment decisions without all the headache come April.
And that brings us to the end of our deep dive. Now that you know the IRS is closely watching your fractional shares and backwards timelines, I've got to ask, what other hidden tax traps might be lurking in your portfolio right now? Let us know what financial mystery you want us to decode next. Keep learning, definitely keep your records straight, and we will catch you in the next explainer.